Hi everyone, in this video we'll be going over accounts 2023 specimen paper 2 question number 3, and the paper 2 is going to be a little bit different as compared to previous paper 2s from examination for 2023 onwards. Previously we used to have 4 questions, 2 of 30 marks and 2 of 15 marks, and we were given a time limit of 1 hour and 30 minutes. But from this year onwards we will be having 4 questions, again of same weightage. So we'll have 2 questions of 30 marks and 2 questions of 15 marks, but we are given additional time limit. So we have 1 hour and 45 minutes, which means that we're given extra 15 minutes for the same weightage. And since question number 3 is a 15 marks, ideally we should be spending about 17.5 minutes to complete this question. And in this video as well, we will be attempting to solve this question under 17.5 minutes. Now, without any further delay, let's get started. The directors of AB plc have decided to make a rights issue and a bonus issue of ordinary shares. We need to identify 2 advantages to the company of a rights issue of ordinary shares. So the very first thing is that rights issue of shares can only be provided to the existing shareholders, which means that no new shareholders can enter due to a rights issue. And due to this factor, it will not dilute the ownership, which acts as a major advantage. Let's write it down. Does not dilute ownership. And the second advantage is that rights issue definitely brings in additional cash, right? Let's write it down. The company will gain additional cash from rights issue. Okay, now we need to write 2 advantages for the company of a bonus issue of ordinary shares. So in rights issue, we used to get additional cash, but remember that bonus issue is funded by the company itself. The bonus issue is funded by the reserves, which means that the company is not going to get any additional cash by issuing bonus shares. So our very first advantage would be that bonus issue is again only provided to the existing shareholders, which would not dilute the ownership. Let's write it down. Does not dilute ownership. And the second advantage would be it will make use of capital reserves. Like I said before, bonus issue is funded by our reserves. Let's write it down. It will make use of capital reserves. Let's move towards the second part. We're given additional information. All right, so equity we have is of 120,000, and each share has a nominal rate of 0.50. We have share premium amounting to 25,000 and retained earnings amounting to 43,000 at the date of 1st January 2020. Then, AB plc has adopted the revaluation model for measuring the value of its non-current assets. During the year ended 31st December 2020, the following took place. On 1st July, the directors made a rights issue of 1 ordinary share for every 6 held at a premium of 0.05 per share, and the issue was fully subscribed. So what this means is that we are providing new 1 right share for every 6 ordinary shares that currently exist in the company, right? Now we need to figure out the total number of ordinary shares we have here. And in order to figure out the number of ordinary shares, we just divide the total value by the nominal rate. In this case, the total value is 120,000, and our nominal rate, as we can see here, is 0.50. So the total number of shares that the AB plc has currently at the date of 1st January 2020 is going to be 240,000. Now we need to figure out the number of right shares for 240,000 ordinary shares. So for 6 ordinary shares, we're providing 1 right share. For 1 ordinary share, we're providing 1 by 6 right share. This is just the unitary method. And for 240,000, so that's 240,000 ordinary shares, we're providing 1 by 6 times 240,000 right share. And 1 by 6 times 240,000 is just 40,000. So at the date of 1st July, we issued 40,000 right shares at a premium of 0.05, right? So by this rights issue, our ordinary share is going to get increased by the value of nominal rate, which is 0.50, times the number of shares, which is 40,000. So that's 40,000 times 0.50, which results in the value of 20,000. And we have a premium rate of 0.05, which means that our share premium is going to get increased by the total number of rights issue, that's 40,000, times our premium rate of 0.05, which results in the share premium to get increased by the value of 2,000. Okay, and in total, we receive the cash, or we can write it as bank. In bank, we receive the total of 20,000 for ordinary shares and 2,000 for share premium. So that's a total of 22,000 in our bank due to the transaction made on 1st July. Now, on 1st August, the directors made a bonus issue of 1 ordinary share for every 5 held on that date. Okay, it just means that we're providing 1 bonus share for 5 ordinary shares at the date of 1st August. Now remember, at the date of 1st August, the total ordinary share value is going to be 120,000 plus the ordinary share that we received at 1st July. So that's 20,000. So the total value now is 120,000 plus 20,000, which results in 140,000. So that's the total value of ordinary shares at the date of 1st August. Right? And we need to figure out the corresponding number of shares as well. That is just going to be value divided by the nominal rate. In this case, that would be 140,000 divided by 0.50, which results in the value of 280,000. So that's the total number of ordinary shares that we have at the date of 1st August. Now we need to figure out the number of bonus shares according to our total number of ordinary shares. So let's apply unitary method again. For 5 ordinary shares, we're providing 1 bonus share. For 1 ordinary share, we'll be providing 1 by 5 bonus shares. And now we need to figure out the total number of bonus shares for 280,000 ordinary shares. That would be 1 by 5 times 280,000 bonus shares, which results in 56,000 bonus shares. And remember that bonus shares can never be issued at a premium, so it only brings in the nominal rate. So our ordinary share is going to get increased by the number of shares times the nominal rate. That's 56,000 times our nominal rate of 0.50, which results in 28,000. So our ordinary shares will increase by 28,000 due to these transactions. And remember, like I said before, bonus issue is always funded by the reserves. So our reserves here is the share premium, right? And the total value of share premium at the date of 1st August is 25,000 plus the value that we incurred from here. Our share premium, extra share premium, is 2,000. So the total share premium we have at the date of 1st August is going to be 27,000. Right? But remember that we require 28,000 to fund the ordinary share, which means that we also need to utilize the retained earnings. From share premium, we get 27,000 to fund the bonus issue, right? And the remaining 1,000 will be funded from our retained earnings. So that's remaining 1,000. All right, we completed the transaction for 1st August. Now let's move towards 30 September. The directors paid an interim dividend of 0.08 per share on all shares in issue at that date. All right, remember that our ordinary share value is again going to be increased by this 28,000 at the date of 30 September. So the total value of ordinary share at the date of 30 September is going to be the previous value, which we figured out right here. That's 140,000 plus the additional 28,000, which results in the value of 168,000. Now we need to figure out the number of shares. So the number of shares is just going to be the value divided by nominal rate. In this case, that's 168,000 divided by the nominal rate of 0.50, which results in the value of 336,000. So that is the total number of ordinary shares that we have at the date of 30 September. And we are providing 0.08 per share. So the total dividend paid is going to be the number of shares, which is 336,000, times the rate of dividend, which is 0.08, which results in the value of 26,880. So that is the total dividend paid at the date of 30 September. Now let's move towards the transaction of 31st December. Land which had cost 120,000 is now only worth 100,000. This has not been adjusted in the books of accounts. So this is a revaluation downwards, right? Revaluation downwards. And the amount is just the difference between these two values. So that's 120,000 minus 100,000, which results in 20,000. Okay, and the thing that we need to remember is that dividend is paid out of retained earnings, right? So this 26,880 is going to be funded by our retained earnings. All right, then we're also given the profit for the year, which is 18,000 at the date of 31st December 2020. Now let's have a look at our question. We need to prepare the ledger accounts to record these transactions. Firstly, we need to talk about ordinary share capital account. All right. We will be starting with our opening balance that we were given at the date of 1st January 2020. We have our ordinary share capital worth 120,000. And remember that we're talking about equity, which is basically capital, right? And capital accounts opening balances is always recorded on the credit side in our ledger account. So let's record it on the credit side. That is at the date of 1st January. We are talking about our opening balance. So that's balance brought down, which had the value of 120,000. And the increments in ordinary share capital account is recorded in the credit side, whereas the decrements will be recorded on the debit side. Okay, then we already figured out the increments in our ordinary share at the date of 1st July. In 1st July, our ordinary shares will be increased by 20,000 right here. And this increment in ordinary share is being funded by our bank balance, right? 20,000, because this is a rights issue, which means that the existing shareholders will put the money in the company's bank account. So our bank account of 20,000 will be funding this increment in our ordinary share value, due to which we will record in our ledger the value of 20,000 under the heading of bank, and we will be recording this on the credit side since this increases our ordinary share value. Let's do that. This is at the date of 1st July. So 1 July, we have bank, which funded 20,000 towards ordinary shares. All right. Then our next transaction is of bonus issue, which again increases the ordinary share value by 28,000. We already figured it out. And this 28,000 is being funded by share premium, which funds 27,000, and retained earnings, which funds the remaining 1,000. So in our ledger account for the ordinary share capital account, we will be recording the amount of 27,000 under the heading of share premium account, and 1,000 under the heading of retained earnings at the date of 1st August to record this transaction. Let's do that. That is 1 August, and we have our share premium funding 27,000 and retained earnings funding the remaining 1,000. All right, then our next transaction was a dividend, which does not affect the ordinary share. And the next one was revaluation, which again does not affect the ordinary share. And we had profit for the year, which again does not affect ordinary share, which means that we recorded all of the transactions required in the ordinary share capital. So now we can move towards figuring out our closing balance. So closing balance will be on our debit side. That will be at the date of 31st December. That's balance carried down. All right. And in order to figure out the balancing figure, we first require the total. We can clearly see that the credit side is the heavier side. So let's figure out the total from this side by adding these four amounts. That's 120,000 plus 20,000 plus 27,000 plus 1,000, which results in 168,000. This will be the total for debit side as well. And in order to figure out the balancing figure, we need to subtract the amounts that we would have on this side from the total. In this case, we do not have any amounts, so that's 0. That will be 168,000 minus 0, which is 168,000 itself. And the next thing that we need to do is to write this closing balance as the opening balance for the next accounting period. Do not forget that. So we will record this again at the date of 1st January, but this is for the year 2021. And these were for the year 2020. Okay, and the heading would be the opening balance, because last year's closing balance acts as this year's opening balance, and the amount is also going to be the same. That's 168,000. This concludes our ordinary share capital. Now we can move to our share premium account. Again, share premium is a part of equity, which means that it is basically capital, right? And the opening balances for our capital accounts is always recorded on the credit side. So that's 1st January, our opening balance. And again, the increments will be recorded on the credit side, whereas the decrements will be recorded on the debit side. Let's have a look at the opening balance. That was given to be 25,000. Let's write it down. Okay, then we had rights issue at the date of 1st July at a premium of 0.05, right? Which means that our share premium account was also increased by this issue, and it was increased by 2000. And this increment comes from our bank account. So increments should be recorded on the credit side. On our share premium account, we will be recording this amount of 2000 under the heading of bank at the date of 1st July. Let's do that. That will be 1st July. Again, this is for the year 2020. That's bank with the balance 2000. Okay, then we had bonus issue, and bonus issue was funded by the share premium. So this amount of share premium had been transferred to the ordinary share account, right? Which basically means that our share premium will be reduced by the amount of 27,000, and the reductions are always to be recorded on the debit side, right? So we can just record this amount of 27,000 in the debit side under the heading of ordinary share, because that is the account which is decreasing the value in our share premium account. Let's do that. This is at the date of 1st August. So 1st August, we have our ordinary share capital, which deducted the share premium account by 27,000. Okay, then our next transaction was dividend, which does not concern our share premium account. We also had revaluation, which again does not concern the share premium account. And we had profit for the year, which does not concern the share premium account, which means that this basically concludes our ledger for share premium. So we can figure out the total. We can see that the total for debit side is 27,000 and the total for credit side is also 27,000. So the ledger account is already balanced. We can just write down the total and then move on. So that's 27,000 and 27,000. Since we did not need to balance anything, we would not be having the closing balance for share premium account. And since we do not have the closing balance, we do not need to record it as the opening balance for the next accounting period. All right, now we can move towards retained earnings account. Remember that retained earnings is also a part of an equity, which basically means that this is also capital, and the opening balances for capital account is always to be recorded on the credit side. So that's going to be balance brought down. And a similar rule will be applied to the retained earnings account as well. The increments will be recorded on the credit side and the decrements will be recorded on the debit side. Let's have a look at our opening balance. So at the date of 1st January 2020, we had the balance of 43,000 in our retained earnings. Let's write it down. That's 43,000. All right. Then the next transaction which concerned our retained earnings was the bonus issue, because retained earnings funded 1,000. So basically we took 1,000 from the retained earnings and put that 1,000 in our ordinary share capital account, right? So our retained earnings was deducted by 1,000 due to the ordinary share capital account. So we need to record this reduction in the retained earnings on our debit side. Let's do that. This is at the date of 1st August. That is ordinary share capital, which reduced the amount of 1,000. Okay, then we paid out dividend as well, and dividends are paid out from retained earnings, which means that basically we will take 26,880 from retained earnings and pay it out to our shareholders. So this is a reduction to be recorded in our ledger, right? And we can record it under the heading of dividend. This is at the date of 30 September. Okay, so reduction on the debit side, 30 September, we have dividend, which we paid out of 26,880. The next thing we have is revaluation downwards, and revaluation downwards is basically a loss, right? And losses are always reduced from our retained earnings. So again, this 20,000 is a reduction that we need to record in our ledger account. And this is the revaluation downwards of land, so we can just record it under the heading of land. This is at the date of 31st December. Again, it's a reduction, so it will be recorded on the debit side. That's 31st December. And this is the reduction of land by 20,000. Okay. Then we were also given profit for the year, which is to be added in our retained earnings account, right? So we need to add 18,000. And adding is basically an increment in retained earnings, which should be recorded on the credit side. And remember that profit for the year is obtained from our income statement, which is now to be referred as statement of profit or loss. So that is the heading that we need to record this amount of 18,000 in our ledger account. Let's write it down. This is at the date of 31st December. And it is from statement of profit or loss. And we have the profit of 18,000. Okay, this concludes all of our transactions. So we need to figure out the closing balance. Again, it is at the date of 31st December. That's our balance carried down. Let's figure out the total from the heavier side, which is the credit side. So that's the total of these two amounts, 43,000 plus 18,000, which results in the value of 61,000. This is going to be the total for debit side as well. And in order to figure out this balancing figure, we just need to subtract these amounts from our total. In this case, that will be 61,000 minus 1,000 minus 26,880 minus 20,000, which results in the closing balance of retained earnings account to be 13,120. And the last thing that we should not forget is to record this as the opening balance for the next accounting period. So this is for the accounting period 2020. Now for the accounting period 2021, 1st January, we're going to have our opening balance with the value of 13,120 because the closing balance of last year acts as the opening balance of this year. This concludes the third question of 2023 Specimen Paper 2. If you found this video useful, make sure you like the video and leave a comment below. And make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.